Imagine flying all the way to a bespoke tailor in Tel Aviv, Israel, just to get a loan for a pair of denim overalls in Ohio.
Right, which sounds completely absurd.
Yeah, I mean, that sounds ridiculous, but as we are about to uncover, it's actually the hidden, everyday reality of the American affordable housing market. Welcome to the Deep Dive.
Glad to be here.
Our mission today, for you listening, is to really take a magnifying glass to a highly detailed financial document. Specifically, we're looking at the Q1 2026 SEC Form 10Q for a company called UMH Properties, Inc.
And we should clarify, we aren't just doing this to analyze a single company.
Right.
We're using this document to understand the underlying mechanics of how the places we live are actually funded, managed, and, well, monetized.
And it really is the perfect lens for that, like whether you are currently frustrated navigating the housing market yourself, or you're looking for investment insights, or maybe you're just insanely curious about how massive corporate landlords operate behind the scenes.
Oh, absolutely. Because SEC filings, especially a quarterly 10Q, are just completely unvarnished.
Right.
They aren't marketing brochures designed to sell you a lifestyle. There are no glossy photos of smiling families. They are the raw legal realities of how a business operates, how it extracts capital, and how it views the economic landscape.
Which is exactly why we're digging into it. It reveals how a company with 145 manufactured home communities across 12 states is navigating a world where, 30-year fixed mortgages are stubbornly hovering around 6%.
Yeah, it's a tough market out there for buyers.
Okay, let's unpack this. UMH Properties operates over 27,100 developed home sites. But as the filing shows, they aren't just selling houses to people. They are orchestrating a massive, highly optimized real estate ecosystem.
That ecosystem concept is crucial here. When most people hear manufactured home community, they usually have this very outdated image in their minds.
Sure, like a traditional trailer park.
Exactly. But from a financial perspective, what we are actually looking at is a highly sophisticated, capital-intensive operation. I mean, it involves specialized real estate, complex joint ventures, and global debt markets.
Before we dig into the actual profit engine, let's briefly look at the macro environment UMH is operating in. If you follow the housing market at all, you probably know the broad strokes here.
Right. Supply is still historically low.
Yeah, sellers are super reluctant to give up those low mortgage rates they locked in years ago, and affordability is just a massive structural hurdle for lower and middle-income households.
And the 10Q acknowledges that friction directly. The traditional starter home is just increasingly out of reach for millions of people. So where do those households go?
Right.
UMH's solution is to lean heavily into rental homes within their manufactured home communities. Out of their 27,100 total developed home sites, they currently operate 11,200 rental homes. And they are aggressively expanding that specific footprint, too. They added 121 net new rental homes just in the first quarter of 2026.
I literally had to read the occupancy section twice when I saw it because the numbers are staggering. Occupied rental homes now represent 44.2% of their total occupied sites. But the metric that really jumped out was the occupancy rate for these rental homes. It sits at an incredible 94.6%.
What's fascinating here is that 94.6% occupancy rate is the ultimate proof of concept.
Oh, so?
Well, it demonstrates that factory-built housing provides the community living people desperately want, and it does so for less than the cost of other affordable housing options.
Wait, let me make sure I'm wrapping my head around this dynamic. It's essentially horizontal apartment building living, right?
That is an excellent way to conceptualize it.
Because instead of stacking renters vertically in a high-rise building with, a shared elevator and zero outdoor space, they are spread out horizontally across 12 states, from New York to Florida, paying for the efficiency of factory-built homes.
Exactly. And because it's horizontal, UMH is managing the land and the infrastructure. I mean, they pave the roads, they maintain the sewer lines, they ensure water delivery.
Almost like a small town.
Exactly, just like a municipality would. But instead of collecting taxes just to break even, they're operating with the profit motives of private corporation.
Right. They've basically perfected this horizontal private municipality model. But to really understand how they capture that massive demand, we need to look at their specific corporate philosophy regarding sales versus rentals. Let's look at the financial picture painted in the Q1 2026 results.
Yeah, the turnaround there is huge.
It is. Their net income swung from a $271,000 loss in the first quarter of 2025 to a $2.6 million profit in the first quarter of 2026.
And the main driver of that turnaround is their rental and related income. That revenue stream hit $59.5 million for the quarter, which is a 9% increase over the previous year.
That's significant.
It is. Their same property community net operating income, or NOI, grew by 7%.
Just to pause for a second for you listening, NOI is essentially the pure cash generating power of the property. It's the money a property makes after you pay the daily operating expenses, but before you pay the mortgage or corporate taxes.
Precisely. And that 7% growth in NOI was driven by two key factors detailed in the report. First, a 110 basis point increase in overall occupancy.
Which, in normal human terms, just means their occupancy ticked up by 1.1%, right?
Exactly, bringing it to 89% overall. And the second factor was a 5% bump in rental rates. So they have more people paying rent, and those people are paying more than they were last year.
I want to push back on something here, though, or at least ask about a weird contradiction in the filing.
Sure, what is it?
Well, UMH doesn't just rent, they also sell homes. The report notes they sold 73 homes this quarter for a total of $6.4 million. The average price was $87,000 per home, and they are making a 36% gross profit on those sales.
Yep.
That sounds like a phenomenal retail business. But later, the report explicitly states that the CEO allocates resources based on community occupancy and rent, and not based on home sales.
That's right.
If you are making a 36% margin on an $87,000 product, why is management essentially ignoring the sales department when allocating capital? Are home sales basically just a loss leader strategy to secure lifelong rent?
That gets to the very heart of their business model.
Yeah.
You really have to look at the underlying mechanics. The 10Q filing explains that selling homes is simply a mechanism to maintain and increase site occupancy.
Okay.
They explicitly state they primarily order homes from factories to fill vacant land sites. The goal isn't to be a massive home retailer. The goal is to maximize that community NOI we just defined.
So it's like the printer and ink model, but they are somehow managing to make a massive profit on the printer and trapping you into a lifetime subscription for the ink. The house is the printer. The land rent is the ink.
That analogy fits perfectly. In a financial sense, the physical house is essentially a magnet for the land rent. Once a home is placed on a site, whether the resident buys that home outright or rents it from UMH, that piece of dirt starts generating steady, predictable revenue.
Because they have to pay for the lot.
Right. The resident pays for the site lease, the utilities, the trash collection. Even if a resident buys the home, they still pay UMH a monthly fee for the right to keep the home on that land. The corporate philosophy prioritizes the recurring high-margin revenue of the land over the one-time transactional profit of selling the physical structure.
Because the costs to operate the dirt are largely fixed. I mean, the roads are already paved, the streetlights are already drawing power. Every additional empty lot they fill, whether through a sale or a rental, drops a disproportionate amount of cash straight to their bottom line.
Exactly. That's why the CEO focuses entirely on occupancy.
So they've perfected this printer and ink model to extract maximum rent from the dirt. But to buy more dirt, build more roads, and order thousands of factory-built homes, they need massive amounts of capital.
Huge amounts.
And traditional local community banks just don't have the stomach or the scale for this kind of nationwide horizontal expansion, which forces UMH to get highly creative with their financing. Here's where it gets really interesting.
It does. The 10Q outlines a multi-pronged approach to funding this expansion, and it relies heavily on strategic partnerships and specialized tax incentives.
Let's start with the partnerships.
Okay, so UMH has established joint ventures with Nuveen Real Estate, which is a massive global investment manager. In these structures, UMH acts as the managing member, but they only put up 40% of the equity capital, while Nuveen puts up the remaining 60%.
If they are only putting in 40% of the cash, how are they benefiting disproportionately?
This is where the mechanics of real estate joint ventures become very lucrative. Because UMH is doing the actual day-to-day work, finding the land, ordering the homes, collecting the rent they charge, the joint venture property management fees, and asset management fees.
Oh, sorry.
But the real prize is what is known as a promote.
Walk me through how a promote actually functions in this context. Because I've heard the term, but it sounds like insider jargon.
A promote is essentially a performance bonus that shifts the distribution of profits. So in this Nuveen deal, there's a target return of 7.5%. Up until the project hits that 7.5% return, profits are split according to who put in the cash.
So 40% to UMH, 60% to Nuveen.
Exactly. But once the project becomes successful enough to clear that 7.5% hurdle, UMH gets a promote. They might start taking 50 or 60% of all profits above that line, even though they only provided 40% of the initial money.
Wow. So it allows UMH to leverage their operational expertise to make outsized returns without tying up their own balance sheet too much.
Exactly. They're using this structure right now to develop a 113-site community called Honey Ridge in Pennsylvania, along with other developments down in Florida.
That covers private equity. But the filing also details how they are utilizing the federal tax code to stretch their capital. They created a 77% owned fund specifically to operate in qualified opportunity zones.
Yes, and this mechanism was born out of the 2017 Tax Cuts and Jobs Act, which was designed to encourage long-term investment in economically distressed areas. For UMH, this is just a masterclass in capital efficiency.
How so?
Well, they had a significant capital gain, meaning a large taxable profit, realized from a previous corporate merger. Normally, you'd owe a massive tax bill to the IRS immediately on that gain.
Right, Uncle Sam wants his cut right away.
Exactly.
But by dumping it into this Opportunity Zone fund, what happens?
They get to defer paying the taxes on that gain until the end of 2026.
Wait, really? Meaning the government is essentially giving them a massive interest-free loan for several years.
That is functionally exactly what it is. And meanwhile, they're using that deferred tax money to buy up distressed properties in places like South Carolina and Georgia, and they're turning them into profitable manufactured home communities.
Okay, so they use joint ventures to leverage private equity, and they use the tax code to stretch their domestic capital. But even that isn't enough to fund a 12-state empire.
That's not.
When you need hundreds of millions of dollars and you want to keep your properties unencumbered, you have to look outside the U.S. banking system. And this brings us back to our tailor in Israel.
Yeah.
UMH is funding itself via the Tel Aviv Stock Exchange.
The Series A and Series B bonds, this is honestly one of the most mechanically fascinating parts of their capital stack.
It really is. The filing shows they have over $100 million in Series A bonds at an interest rate of 4.72% and roughly $80 million in Series B bonds at 5.85%. These are issued to investors in Israel, and they're denominated in Israeli shekels. Why go all the way to Israel to fund American manufactured housing? Like, I'm just picturing a guy in a suit in Israel holding the deed to a trailer park in Indiana.
Well, it comes down to two things: unsecured debt covenants and global yield hunger. And to your point about the deed, let's tackle covenants first. If UMH goes to a U.S. bank for a loan, the bank usually wants a mortgage on a specific property as collateral.
Right, secured debt.
Exactly. It ties up the property. UMH can't easily sell it or alter it without the bank's permission. Unsecured debt covenants, on the other hand, are rules the borrower must follow, like maintaining a certain overall net worth, but they don't pledge specific trailer parks as collateral.
Which gives UMH massive operational freedom.
Yes.
And the Israeli bond market is more willing to offer that unsecured freedom to U.S. real estate companies than domestic banks are.
Historically, yes. The Israeli market has been very receptive to U.S. REITs for this exact reason. But here is the critical mechanical detail you mentioned earlier. The bonds are denominated in shekels, but they're linked to the U.S. dollar.
Explain why that linkage matters. Because my first thought was, if I'm collecting rent in U.S. dollars in Ohio, and I owe interest payments in shekels in Tel Aviv, aren't I taking on a massive currency risk?
Oh, completely.
Right? Like if the shekel surges in value, my U.S. rent checks suddenly don't cover my Israeli debt.
That is exactly the risk, and it's why the U.S. dollar linkage is vital. By legally linking the payout of the bonds to the U.S. dollar exchange rate, UMH shifts the currency risk away from themselves.
Oh, I see.
They effectively lock in their borrowing costs in dollars, ensuring that the rent collected in Indiana or Ohio perfectly matches the debt obligations in Tel Aviv, regardless of what global currency markets do.
It's the financialization of the neighborhood. The local dirt is packaged into a global financial instrument, heavily protected against exchange rate volatility. A family renting a manufactured home in Indiana is indirectly but very securely paying a return to a bondholder in Tel Aviv.
It shows that local affordable housing is no longer just a local issue. It's an international financial asset class.
So UMH is highly calculated about extracting capital from across the globe. But what they do with the cash they actually keep on hand is equally fascinating to me. The financial filings reveal what is essentially a $1 million side hustle.
Yeah, they aren't just leaving their excess capital in a standard corporate checking account earning minimal interest. UMH holds a $26.4 million portfolio of marketable securities.
Okay.
And specifically, these are common and preferred stocks and other real estate investment trusts.
Which raises an immediate question for me. Why is a company dedicated to running its own real estate communities essentially de-trading other real estate companies' stocks? It seems like a huge distraction from their core business of filling lots and collecting rent.
It might seem that way at first glance, but the filing outlines the strategic rationale. First, we need to understand the scale here. While $26.4 million sounds substantial, it only represents about 1.2% of their total undepreciated assets.
Meaning their total assets before accounting for the wear and tear deductions over time.
Right.
So 1.2% is a tiny fraction of their balance sheet. They aren't betting the whole company on the stock market.
No, not at all. The report explicitly states that this portfolio provides the company with three things: diversification, liquidity, and additional income. And the liquidity aspect is the most mechanically important.
Because real estate is super illiquid.
Inherently, yes. You cannot sell a 200-home neighborhood in an afternoon if you suddenly need cash to cover an unexpected expense or, to seize a fast-moving acquisition opportunity. But you can liquidate $1 million worth of publicly traded REIT stock in seconds.
So it acts as a highly accessible financial shock absorber.
A shock absorber that also generates a return. In the first quarter of 2026, they netted a $2.7 million gain on this portfolio. Now, the accounting mechanics of that are pretty revealing.
Walk me through it.
That net gain consisted of a $39.1 million increase in the fair value of the securities, which was offset by a $36.4 million loss.
Let's break that down for the listener. Fair value just means what the stock is worth today on the open market. So they didn't necessarily sell all of those stocks to lock in that $39 million gain, right?
Correct. Accounting rules require them to mark to market, meaning they have to report the fluctuating value of the portfolio on their income statement, capturing the volatility even if they are just holding the assets. They are using their deep specialized knowledge of the REIT sector to make a return on their cash reserves. They're accepting a bit of paper volatility in exchange for having that cash relatively accessible.
So what does this all mean? We started this deep dive with a stack of dry SEC financial tables, just line after line of corporate numbers. And we've uncovered a massive interconnected ecosystem.
It really is.
We've seen how global unsecured debt from Tel Aviv, highly structured joint ventures with private equity, and this relentless focus on capturing land rent over home sales are actively dictating the reality of the affordable housing market in the United States.
It highlights that the housing market is this complex web of capital allocation. And for you listening, whether you are renting your home right now, buying property, or investing in the broader market, it is crucial to understand the mechanics at play here.
Absolutely.
You are participating in a market that is increasingly optimized, financialized, and globalized by entities like UMH. Knowledge is most valuable when it is applied. The next time you see a new housing development, look past the physical structures. Look at the infrastructure, consider the dirt underneath, and realize that it might just be a carefully engineered node in a much larger international economic machine.
And that brings us to our final thought. We've seen how brilliant this business model is mechanically, right? How securing the land while treating the physical houses as mere tools to capture monthly rent is incredibly profitable and highly resilient.
Yeah.
But it leaves us with something pretty profound to mull over. If massive corporate entities are perfecting the art of horizontal affordable housing, securing the dirt, and optimizing every square inch for recurring yield, what happens to the classic American dream of the starter home?
That's a great question.
In the future, will the working class ever actually own the dirt beneath their feet? Or will starter home ownership be entirely replaced by starter home rentiership?